Hello everyone, Mr. Lipchick here, and this segment of instruction is about measuring market performance. A bull market is defined as a steady rise in the stock market over a period of time. Stocks are more heavily purchased over a period of time. The 80s and 90s were a bull market period. And a bear market is a steady drop in the stock market over a period of time. From about 2000 forward, a bear market began. The Dow Jones Industrial Average is an index showing average daily trading of the 30 largest companies in various industries. The S&P 500, or Standard & Poor's 500 index, shows price changes for 500 different stocks from the NYSE, NASDAQ, and OTC markets. The 1929 crash. The decade of the 1920s was a bull market, with trading growing by billions of dollars. The nation had mistakenly come to view the stock market as the primary measure of the economy's health. Workers' wages had not kept pace with economic growth, and they could not afford the new inventions of the 1920s. Stockpiles of appliances and other goods grew, and workers were laid off. Farmers were suffering because of increased production and falling farm prices. The market did not reflect the true economic realities. The market was growing, the economy was not growing. In other words, the price of all these stocks was inflated. The decade of the 1920s was a decade of extreme wealth and extreme poverty. In addition to a weak economy, the stock market was full of speculators. Speculation is making high-risk investments with borrowed money in the hopes of getting a big return. That is called buying on margin. By September 3rd, 1929, stocks were trading at an all-time high, and some investors were nervous as they knew stocks were overvalued. On October 29th, 1929, otherwise known as Black Tuesday, the market started to crash and people sold their stocks in a panic to redeem what money they could. Bank runs and economic panic ensued, and the Great Depression set in. At the height of the Depression, over 33% of the population was unemployed. Other market crashes. October 18th, 1987, Black Monday, the Dow lost 22% of its value. The Fed lowered interest rates immediately to stimulate the economy. Within 2 years, the stocks were back to pre-crash levels. In 2000, stock prices began to drop as investors felt that stock prices were overvalued. The 9/11 terrorist attacks added to the crisis. In 2002, Enron and WorldCom, major corporations, declared bankruptcy and announced that they had been issuing false financial reports for many years. Stock prices fell even further. Currently, the market is in a very slow state of recovery. That concludes our discussion of market performance. Thank you for viewing, and I look forward to seeing you in the live lesson. Have a great day.